The single chart that predicted every market crash, and it's flashing red again. Black Monday, the dot-com bubble, the 2008 financial crisis. What if I told you that every major market crash in modern history had one thing in common? A single chart that predicted them all, the 10-2 bond spread. It's Wall Street's worst-kept secret. Yet most people outside the financial world have no idea it even exists. But here's the real shocker. Right now, it's flashing warning signs that are impossible to ignore. Today, I'm going to break it all down for you. What the 10-2 bond spread actually is, how it predicted every major economic disaster, why it's screaming danger right now, and most importantly, what this means for your money and how you can prepare. So before we dive in, make sure you hit that like button and subscribe, because what you're about to learn might just save you from the next market crash. What is the 10-2 bond spread, and why should you care? Alright, so what exactly is this 10-2 bond spread that has predicted every market crash for decades? Let's break it down as simply as possible. Imagine you're lending money to someone. If they ask for a short-term loan, say 2 years, you'd probably charge them a lower interest rate. But if they ask for a 10-year loan, you'd charge them more because, well, anything could happen in 10 years. Inflation, recessions, financial crises, who knows? That's exactly how the US bond market works. Normally, the 10-year Treasury bond pays a higher interest rate than the 2-year Treasury bond. Longer loans, more risk, higher interest. Shorter loans, less risk, lower interest. But sometimes this flips. When the 2-year bond starts paying more than the 10-year bond, that's called an inverted yield curve, and it's bad news for the economy. Why? Because every US recession since the 1970s has been preceded by this exact scenario. Every single one. It's like the Nostradamus of finance, except with real data. Why does the 10-2 bond spread predict recessions? Okay, so we know that an inverted yield curve is a bad omen. But why does it predict recessions? It all comes down to how banks and businesses react. 1. Businesses stop expanding. When short-term interest rates rise, it gets more expensive for companies to borrow money. Imagine you're a business owner. You want to take out a loan to expand, hire workers, or invest in new technology. But suddenly, bam, loan rates skyrocket. What do? You hit the brakes. No more hiring. No more expansion. Maybe even layoffs. This slows down the economy, creating a ripple effect that hurts everyone. 2. Banks start losing money. Banks make money by borrowing at short-term rates and lending at long-term rates. When the 10-2 spread shrinks or inverts, banks suddenly can't make a profit on loans. Less lending, less economic activity, higher chance of a recession. The market's biggest fear: investor panic. Now, here's where things get really scary. When the 10-2 spread goes negative, it's like a big neon sign flashing. Trouble ahead. Investors freak out. They start pulling money out of stocks. They pile into safe investments like bonds and gold. This panic causes stock prices to drop, sometimes even before the real economic pain begins. It's like being in a crowded movie theater when someone suddenly yells, "Fire!" Even if there's no fire, people panic and rush for the exits, causing chaos. That's exactly what happens in the markets. The 10-2 bond spread is screaming danger right now. So, what's happening today? Well, here's the bad news. The 10-2 bond spread has been negative for months. And historically, when this happens, a recession follows within 6 to 24 months. But that's not all. The 10-year Treasury yield is hovering around 5%, a level we haven't seen in decades. The yield curve has been inverted for one of the longest periods in history. The Federal Reserve keeps hiking interest rates, making borrowing even more expensive. The U.S. government just issued $119 billion in new debt, raising concerns about sustainability. Folks, this isn't just a bad sign. This is like Mother Nature putting thunderclouds on the horizon. The storm isn't just coming, it's already forming. What should you do now? Okay, so we've established that the bond market is screaming warning signs while the stock market is still acting calm. So, what should you do? 1. Rebalance your portfolio. If you're heavily invested in high-risk stocks or speculative assets, it might be time to diversify. Look for quality companies with strong cash flow, low debt, and solid fundamentals. 2. Hold some cash. Yes, cash isn't trash. Having cash on hand lets you buy opportunities when the market dips. Just ask Warren Buffett. He's sitting on $325 billion in cash right now. 3. Avoid panic selling. Remember, markets go down, but they also go back up. Selling everything in a panic locks in your losses, while patient investors make big gains during downturns. 4. Look at international markets. The US isn't the only game in town. Diversifying globally can protect you from domestic downturns. Final thoughts. Will you be ready? Host. Engaging tone. History tells us one thing for sure. When the 10-2 bond spread inverts, recessions follow. This time, it's no different. The real question isn't if a crash is coming. Drop a comment below. Do you think a market crash is coming? And if you want to see which stocks the smart money is buying right now, click the video on the screen. Don't forget to like, subscribe, and turn on notifications for more insights on how to protect your wealth in uncertain times. See you in the next video.